Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today we're going to do a deep dive into what is almost a year's worth of data, where I've been collecting and studying the Euro USD market on 4 different demo accounts with 4 different settings. The results are very interesting. What we have on the screen is a live market. What is going on right now with my real open positions all along here. These are real money positions, and you can see on the side over here real profits I have taken from this account. These profits have of course been very tasty and delicious, but along the way I have had a few bitter losses. That is simply the way of trading. You're going to have losses along the way as well as profits. But this brings up something that I have spoken about countless times: the importance of a demo account or paper trading and running simulations for a long period of time. It is time to show exactly what these results are, and they are quite fascinating. But first, before we get into the actual charts, we need a little bit of history. That history starts with the market. Now this is an analysis of the Euro USD market. The highest time frame is monthly. And that is important because the duration we're studying is 22 years of data. Now realistically, this information is available for the cryptocurrency markets as well, and I encourage you to absolutely use this information, because this is what will make or break your trading. And there is a lot of information here that you really need to focus on critically and carefully. And we are going to go over all of this information. Let's start with right at the top: the highest market value, the lowest market value, and the spread or distance between the highest and the lowest. This is, for all intents cases, a worst case scenario. So if you was to divide this to 100 positions, each position would have to be a distance of 671 pips apart to ensure you didn't blow up your account, providing you didn't over leverage it. But that really is a difficult process to cover that much space in the market. But this is the worst case right here. Well, it'd help if I could draw, right? 6,710 pips of movement throughout the entire 22-year history of the market. Now the second section we're going to look at is the market median. The median is just basically the highest and the lowest, and then that gives you a midpoint between those two. So 1.2684 is the price that is the median for the market. Now below that, above, below, and split. These are important because the above represents the number of times the price went above the median, or 30% of the market has been above the median. 59.33% of the market has been below the median. These two figures help you decide whether you should be in a long position or a short position. And looking at this, for purposes of rounding, 30% of the time, long positions were profitable. 60% of the time, short positions were profitable. So if you are in a situation where you can only open up one direction for a long-term process, such as a floating grid bot, then you're going to want to go with the side that is most likely going to give you the most profit, 60% of the time. So just by looking at the median, we can see that 60% of the time we could be in profit. But there's more to it than that. Now we look at the market average. That is, we take a look at the prices within the market itself throughout the entire 22-year period. This is an interesting number, 1.2220. What's interesting is it is below the median. The median is 1.26. The average is 1.22. The fact that the average is below the median supports the belief that the market is mostly short-sighted. That's a critical emphasis in terms of more information that you can use for your trading. Now let's look at the above, below, and split. Above the average is 40% of the time. Below the average is 48% of the time. And then, of course, where the average is split. So even though the median is 60% below the average itself is only 48%. Or I should say, the median shows 60% prices below it. The average is only 48% prices below it. But in both cases, the median and the average show a propensity that you are more likely to be more profitable on the short side of the market than the long side of the market. That is, these two indicators tell you that the market is predominantly going downward. Throughout the whole history of the market, it is predominantly a downward slide. But the truth is what happens is you end up with a downward slide, then you get a huge upswing, and then another downward slide. That is, you have these odd cycles where the market takes on a huge jump in value before it hits a heavy correction period where the prices drop back down below the median and the average. And that brings us to looking at the maximum amount of movement for the highest time frame. And this is really the big numbers. This is really what helps you decide your stop losses, or just how far the market is likely to move against you if you have a really bad situation. So looking at these two numbers here, the maximum monthly movement is 2,171 pips, or 13% of the total volume of the market. Total volume being described as the spread of the highest point and the lowest point, as demonstrated up here. So 13% of the market is the maximum worst case situation. This is a 1 month movement where the market just really rocked it out of the park and went in one single direction in a huge force. But the big number, the one that gives you a reasonable level of expectation, is the average monthly movement. On average, throughout the entire 22-year period of this market, it has moved 482 pips, or roughly 3.01% of its volume. That's critical because that gives you a reasonable representation of what to expect for an average monthly movement. So if you want to be able to make money in the market, then you need to be able to think about the market in this kind of a worst case scenario context. You could use the maximum, and that would work well, in which case you would always be prepared for the worst possible chance the market could really move. But you don't really need to think about the maximum because you know how many times the average has been broken. And that really is right here. The market has gone above the average movement 107 times out of 268 times. In this case, these represent months. So 40% of the time, the market has gone above its average. That automatically gives you a 60% winning possibility, even if you do crazy stuff like flipping a coin or just taking random trades. Statistically speaking, you have the probability of a 60% profit. That is, of course, not guaranteed, not by a long shot, and the market can come back and bite you with an aggression that can destroy you. We already know this, we've seen it. So when you're looking at your numbers, the numbers that I use on my trading, and the numbers that I have spent almost a year testing, roughly 9 months, is whether or not this actually holds true. Does it hold true that if I can weather 480 pips, that I will stand a better chance of profiting without hitting stop losses? That doesn't mean that I'm never going to hit a stop loss. That just means that, probability speaking, I have a statistical likelihood of not hitting a stop loss. This is the kind of analysis you need to make before you start trading. Because now that we know that we have a 60% chance of profitability, no matter what strategy we use, we can then begin to look at the strategy itself and determine how can we make those chances even more likely to go in our favor. Again, I emphasize, you have no guarantees of profit. All you're doing here is putting statistics on your side that you are going to have a better chance of making a profit and keeping your profit. That is critical. So as we progress and we start getting to the next part of this discussion, this number $482 pips is critical for this discussion. We have to keep this in mind because it will become very apparent why this number is so important very quickly. So let's get into the charts and actually see exactly what I'm talking about. Okay, we have 4 charts on the screen. All 4 charts are of Euro USD. All 4 of these markets started with $1,000. They are identical in their starting point, and they are identical in a rough duration. Some accounts started mid-January, while others started very late December. So for the purposes of the scale below, you'll see the significance of the timing. And that would be right here on the bottom of the chart. I've tried to make this as much of an apples to apples comparison with the market dynamics as much as I could, where the only thing that is different is the risk versus reward, or the take profit versus stop loss. In the context of the floating grid strategy, it's basically the number of levels in the grid, which range from 43 to 100. And those levels are based upon various scales. Whether I am hyper aggressive with only 2 pips per trade, or hyper defensive where I've taken my 500 pip range, or 486 pips, and I've divided it by my levels. For example, if you look at the chart and you see the equity curve, and let me bring up a calculator real quick and do some math. Looking at the 486 pips, if you have a 43 level grid, you should have 11 pips per level. That isn't always the case. And as you can see from the chart we are looking at on the screen right now, Blueberry Cobbler Euro USD, I used a different scale than 11 pips. We can see when we look at the chart, and this is where things really become critically important. The first time I took stop losses, clearly shows that the market moved. But then I had a very generous, really generous upward swing. The market just went crazy. But then I had one of those months where it broke the average, and I moved well beyond the average. But because I didn't even cover the average in the number of pips, for example, for this particular bot, I only covered about 300 pips movement, not the entire 486. So I took a series of brutal cascading losses because I didn't cover the worst case situation of the market in this account. And that is a big problem that gets seen over and over as we progress through this trading situation. When the market runs in your favor, whatever direction that is, you're going to do incredibly well. Once in a while, you're going to get a normal, painful bump, and you're going to lose a little money. But every so often, you're going to get the big monster move. The move that is the worst case scenario. And when it happens, it's going to hurt. This is a clear, direct symptom of what happens if you don't give your stop losses enough room to breathe, and you don't plan out your market enough. This is why you need to plan carefully and trade long term in a paper trading environment or demo account. We can see 9 months worth of history here. And at any point, if I'd stopped prior, I would not have actually seen the history of the market take on such a huge move. Over and over, I see this every day where people don't take the time to really test and watch the market in a meaningful way. And when this day comes, the day that the market just dives against you, it's a surprise if you don't see it coming. Because I have this information, I've been able to adjust my own personal trading to see just what the market is going to do and plan for a worst case scenario. And this is definitely a worst case scenario. This is a huge jump that wiped out $250 of profit. In fact, it actually cut down into my initial balance, as we can see at the very bottom. Down here, we see it goes below the zero line. So I actually lost some of my initial balance. That is painful. Now let's move to the next account and see what secrets it holds. French Vanilla is an interesting account because I actually do trade the worst case scenario. But in the beginning, back here, I didn't. When I first started the account, I didn't plan for the worst case scenario. I didn't have my market set to weather 486 pips of movement. Now, I've been lucky here. Let's just put this straight out on the table. This is luck. The fact that this account has not taken any stop losses since I made the initial adjustments back in February of 2024 is pure luck. At some point, it will take a stop loss. End of story. But the point being that because I did take into account the worst case market situation of a 500 pip movement, I have been able to weather the market reasonably well. So now let's look at a third account. Again, remember, these are all the same assets with different settings. And this one took a more heavier beating than even the Blueberry Cobbler, because this one was more aggressive. So we can see the aggressiveness and the lack of planning really hurt the account significantly. So much so that we ended up almost $200 into our initial balance. So unlike the last account that had some losses where we were only $10 into our initial balance, this one is $200 into the initial balance. It hurt badly. Aggressive trading only works if you have the balance to back it up. If you don't have the balance and you over leverage the account, it will bite you hard. It will decimate your balance. You need to be careful about that. Here we can see a tiny little stop loss right there. Nothing to worry about, something you would expect. But when you get to the bigger stop losses, and then they start cascading, then things become a problem. Because as soon as you get cascading stop losses, that is a sign of a failed plan. That doesn't mean the technique failed. It means your level of planning failed. This is why you need multiple accounts running the very same technique with different settings. Because some techniques will fail and you will see it across every single account. But in this case, we can clearly see that the technique is successful, but it's just the planning that failed. So now let's look at the last account. And we can see yet again the upper range, the amount of profit it made until it began cascading. Which overall, this is not bad. It's still too aggressive because we still have these cascading losses. But they're not like the last account. This account is still about $180 above its actual zero balance line or initial budget. So overall, this account is successful. It's not as successful as French vanilla, but it is successful. But the other thing to pay attention to when you're looking at these accounts, let's take, for example, Strawberry Delight compared to French vanilla. Let's look at the top line. You're looking at a $350 profit. And it took place over 9 months. That's not necessarily spectacular. Worst case scenario planning takes longer to profit from because you're making smaller profits for every single trade. It's a bit of a more defensive approach. Whereas if we look at Strawberry Delight, we can see that it made way up in here, which is probably about $430, $450 range. So it made roughly $100 more than the French vanilla account. So even though it took this huge loss and lost, well, half of the earned amount, the risks for this type of a situation might still be worth it because it's still in profit. And it's more likely to earn more profit than French vanilla, which means it's likely to recover quicker from any losses. But that is the kind of decision making you need to make when you are planning your trading. How aggressive do you want to be? If you want to be just a tiny bit aggressive, as Strawberry Delight is, it can still work out well. If you want to be more defensive, like French vanilla, then you're going to get a long-term, very generous profit, even though those profits are reasonably not going to accumulate as quickly as a more aggressive approach. If you get too aggressive, you're going to lose a lot of money. straight out bottom line, too much aggression is bad. Even if you get to the point that you want to take a little bit of aggression, but still want to get just on the edge of too much, it can work if you have the risk assessment for it. But this is still just a little too much. Really, French vanilla and strawberry delight demonstrate a level of aggression that is practical for long-term success. In both cases, they do have the worst case scenario plan. French vanilla is the worst case scenario plan. It weathers the market very well. It survived 9 months of an insane, crazy market with some really huge moves. And when I mean huge, I mean huge. But Strawberry Delight, a little bit of aggression, pushing the edge just a little bit, but still in profit. Now, you have to decide, where do you want your trading to be? Now let's look at 4 more charts that take this to the next level, or the next level of understanding, I should say. Now we are going to look at the cost of walking away. If you were to sell out completely and walk away, what would you make right here and now? And we can clearly see right now we would lose money. This is also a consideration when you look at your trading style, technique, and market situation. As we can see though, when we look at the market, the zero line is what it would be if we had no positions. Meaning if we sold everything out, not counting profits, we would be right back where we were with our initial budget. Anything above the zero line means that we've accumulated profits if we were to close out completely. This type of analysis helps us see the long-term consequences of trading. And there are always long-term consequences. You must always look at what happens if you want to walk away from the table. Blueberry cobbler, not good. French vanilla. French vanilla is a serious bite, because even though it's a worst case scenario plan, that plan relies on being in the market. And that means if you walk away right now, you're going to lose about $600. Which is fine, because this is not realized losses. This means if you were to sell out the market right away, it's not necessarily a good way of looking at the market, depending upon your risk assessment. If you're someone that doesn't want to commit a year or more to a single asset, then this type of a trading technique may not be appropriate for you. But you're not going to know that until you spend time trading. The other thing to pay attention to with this market is that the exposure rate is pretty consistent, which is a good thing because it tells you about the stability of the technique and your settings. This particular market is really pretty stable, which is good. Now let's look at lemon meringue. This one is a stinking hot mess, which we saw in the equity chart. If you walk away right now, you're going to take a hit of $1,500. This is a painful one. That big cascading loss had a huge impact on your exposure. That cascading loss translated into direct realized losses. And that is going to hurt your exposure altogether, because you're going to have to earn back or earn more to offset that cascade. And that's going to require more time. But we can see, though, that the aggressiveness did well when it did well. When it was moving in the range of the market, it did very well for its exposure. But that's not always the case, and that's not always something we can guarantee. The final account, Strawberry Delight. The one that is just a tiny bit aggressive, but you still feel that nasty bite when the market moves beyond the average. If you can weather that kind of a risk, it's worth it. Right now, we're going to lose about $400 if we walk away from the table. So it is slightly less losses than French vanilla, but French vanilla has slightly better long-term cascading profitability. Now let's look at the actual trading approach. So I'm going to bring up 4 more charts, and we can see how the market actually played out for these exact same accounts. These charts are going to be quite a bit heavy because I track a lot of information. But nonetheless, they are critically important because they show a huge array of circumstances. As we look at these charts and we look at the various locations stop losses actually took place, we can see the impact of the stop losses within the floating grid technique. And that really is something to be aware of. As you decide your technique, these losses are harsh. They hurt. And all of the incredible profits aren't going to matter when you have losses at this level. But there are techniques that you can do to offset your losses. And that is what really this experiment is about. As we look at this next chart, and it is a very heavy chart, to be honest. There's a lot of trades on this chart. It uses multiple techniques aggressively. And as it loads, we see something unique about this chart. The cyan-colored lines. These are position reductions, meaning every time we take a profit, we take a tiny loss on the oldest position we hold. So every time we walk away with a big profit, that tiny loss at the bottom offsets. So that's why this one only made $350 in profit, whereas Strawberry Delight made $400 in profit. It aggressively uses the reduction strategy as a way of offsetting its losses at the bottom. Whereas the previous chart, Blueberry Cobbler, there was no reduction. So when the loss took place, it took the full weight of that loss. Here, every profit burns off the oldest position. So over time, if you have a position that has 200 units, and you take 200 profits, you have completely erased the oldest position without taking that loss in one big chunk. So by that offset, you've created a dynamic that mitigates when the market moves against you. Now that doesn't always work, and sometimes the market can cascade against you and it hurts, and you're still going to take a loss. But for the most part, when you take advantage of this type of a heavy situation, it is a beautiful mitigation technique. You'll also notice here that it is more aggressive. That is, the distance between each of the trades isn't as much as the other charts. That's important because if you go back to Blueberry Cobbler and you look at the distance of the trades, you see more space between each trade, or more spread. The more trades you do at smaller amounts can be beneficial for hyper-aggregating profitability. Larger trades have larger risks. So it's part of your balancing technique, where in this case, the approach and the strategy I used was taking a look at the maximum number of pips I needed, but a lower level of trades to get more profitability per trade. On French vanilla, I've taken a higher number of trades, but less profitability per trade. That is, I've hyper-aggregated my profitability. So where Blueberry Cobbler only took 43 levels, French vanilla has 124 levels. The distance between the levels is directly correlated to the amount of profitability that each level can take, because each position is drastically smaller. Blueberry Cobbler might use a position size of 600 units. 600 units is going to average about 30 to 50 cents. So we'll just say 30 cents. That's per trade profit. But French vanilla is only going to use about 150 units, which means its profitability is only going to be 10 cents per trade, drastically smaller. And sometimes it's even less than that. Sometimes profit per trade is only at 8 cents or less. So the smaller the unit size, the less profit you're going to get per trade position. But because I'm taking more trades, I'm aggregating that profitability in a way that helps me burn off the bottom of the grid quicker, or getting rid of older units faster. So when the market does move against me, as it has here, I've burned off the oldest positions in such a way that they don't exist anymore. So every time an old position burns off, the next oldest, and then the next oldest, and then the next oldest gets targeted until I am moving and staying within my worst case scenario range. So it's not that the market isn't going to move. It's that the strategy allows me to stay within that worst case scenario by looking at the market as dynamically as I can. By taking these micro losses along the way, I am moving the bottom of my grid to match where the market is moving. But instead of taking one solid loss that's going to burn, I'm taking a small loss. This takes a little off the profit. For example, if I make a 10-cent profit, but I lose only 1 or 2 cents per my micro loss, I'm still 8 cents ahead. And that is a suitable way of dealing with a moving market. So now let's look at the next account and look at what happens with the cascading losses and the techniques that this particular account used in its trading. It's a little more aggressive than Blueberry Cobbler in that I had 73 levels, whereas Blueberry Cobbler only had 43 levels. But it still has some techniques that are important. You'll see that I did use some reduction. Whoops, that's not what I wanted. Let's reset that. I did use some reduction, and that reduction did help. Okay, now that we've got the chart back, I did use some reduction in lemon meringue, and you can see that it did help, but I didn't use it enough. I didn't really take advantage of it the way French vanilla did. So reduction is something that when you use it, you really have to use it. It's not just a when you feel like it approach. It's a technique that you need to really drive home to take advantage of what it offers. And we can see where the biggest cascading losses had their biggest impact. But we can see clearly from this chart that had I used more reduction, it would have had a better outcome. It would not have necessarily stopped the losses, but it would have mitigated the severity of the losses. Now let's look at the last account in this lineup. The second best account that really worked well in both equity and trading, and see how it stayed above the initial profitability line or the initial budget. We can see here that I used more reduction. Not as much as French vanilla, but we can still see the clear impact of the reduction through the cyan lines. It had a major impact. It still couldn't weather the sharp market movement. That was still a painful, brutal approach. So the over-aggressiveness of this particular account was still felt, even though the reduction did help it some. And that is one of the critical points to always think about when you're looking at your trading approach. What works, what don't work. What we do know is what doesn't work is being too aggressive. Too defensive is always better, even though you lose profitability because of the defensiveness. Finding the sweet spot between aggression and defense is a balance. And you have to balance your aggression versus your defensiveness. You have to balance making money versus risking money. In both cases, that pivot point is you. You are the deciding factor in the middle of all of this mess. Your risk assessment, your ability to decide how much you want to risk, the amount of testing, the amount of analysis, the number of sub-accounts and tests you run, all play a factor. And one of the biggest questions that always comes up, that I'm always asked: how do you know when it's time to move from a demo account to a live money account? And that answer is very simple. When you are ready to accept losing every single penny you have invested, then you're ready to move to a live account. Until you reach that point, you're not mentally ready to deal with the losses that are going to come with trading. You must realistically be willing to lose everything you invest. Then and only then are you ready to put real money into the market. Don't try to rush the process. So as I've demonstrated throughout all of these charts, different trading strategies have different outcomes, even if it's the same market, the same market conditions. You're not going to get the same results. Slight changes in your technique or your settings have significant impacts. The most aggressively defensive, meaning you weather the worst case scenario, is always going to give you a better probability of not taking losses. That doesn't mean you aren't going to take losses. That just means statistically you have a better chance not to. That is really the biggest point of the entire discussion. Plan your trades with a statistical probability in your favor. Look at the market, figure out what the market is. If you know you have a 500 pip range worst case scenario, but you can only afford 50 levels, divide it and then use that as your basis and stay with that approach. For example, in that case, it would be a position every 10 pips. Worst case situation. If you can handle more, fine. But do not, under any circumstances, over leverage your account, or you will wipe it out and lose everything with a margin call or a liquidation. Trade smart, trade safe. If you found this information useful, please hit that like button. If you're not subscribed, please subscribe. If you want to support this kind of content, please either join my Patreon or GitHub sponsors so that I can continue conducting these kinds of experiments. This is almost a year's worth of data, 9 months, that I've collected on a myriad of different accounts. Now this is just strictly Euro USD. I have done this to several other different trading pairs, and we will in the future go through them the same way I went through this one, showing the different settings and talking about the different aspects. Leave a comment, share your thoughts, and let me know what you think. Have you done this kind of extensive testing in your trading? Let me know. Thank you for watching, and until next time.